Hi, welcome to Christensen Wealth Management. I'm Michael Christensen, and thank you for taking time out of your day to watch this stock market update for the week ending Friday, July 20th, 2018. July 20th is a very important day in history. It is, in fact, my birthday, and I'm looking forward to it. I have some fun events planned with my family and friends. Moving on to the quote of the week, I have another quote from Zig Ziglar. I talked about him a few weeks ago. Here's a good quote, and this one says, "Rich people have small TVs and big libraries, and poor people have small libraries and big TVs." Those are some wise words from Zig Ziglar. Well, the stock market has been pretty quiet since my last video, but other markets have not been. The currency markets are kind of all over the place, and most of it is due to the devaluation of the Chinese yuan against the US dollar. Normally, the yuan is pegged to the US dollar, which makes it easier for our two countries to trade goods and services with one another. But when it is in the interests of China, they have the right, and often do, devalue the yuan against the US dollar. And they've been doing so since April, very rapidly as a matter of fact, and it's causing much discomfort in many markets around the world. Here is a chart that shows you the value of the yuan from April going all the way down to where we are today. That is a 12-month chart, but since April you can see the very steep decline. Well, the strengthening dollar, which is what happens when China devalues their currency, has prompted Donald Trump to come out on CNBC today with an interview with Joe Kernan, and Donald Trump said he is not in favor of the current strengthening dollar, nor is he in favor of the Federal Reserve's interest rate policy of continuously raising interest rates. So those two things, currencies and interest rates, may in fact ignite some volatility between now and the end of July in many other markets, specifically stocks and bonds. So we'll just wait and see if this interview from Donald Trump and his words creates some volatility in those other markets. We'll take it one day at a time, and let's just go ahead and look at how things are doing today, beginning with the Dow Jones Industrial Average. Looking at this 8-month chart of the Dow Jones Industrial Average, we are still in a sideways consolidation. The Dow hasn't gone anywhere since February 2nd. It's just been a choppy mess to sideways. Technically, you could say the Dow is exactly where it was on January 4th as well. So again, that's a long time to have waited. But right now it is heading down again on July 19th. We may have peaked on July 18th after we came up to the same level of resistance as these other prior highs. I will go ahead and draw that line in. We have this high here from June 8th and 11th and 13th. We've got these highs over here from March and February. So those prior highs are definitely holding some resistance against the Dow and preventing it from getting higher. Let's just wait and see if the Dow continues to go lower over the next few days. And what I can tell you is that the 5-day moving average in red is above the blue 20-day moving average, which does confirm a short-term strength signal. But the bigger problem is that the blue 20-day moving average is below the purple 50-day moving average, which is an intermediate term weakness confirmation, and that holds a lot more importance than the short-term signals. So for right now, remain cautious because we need to get above this June high to consider the Dow Jones Industrial Average as being more bullish, because it definitely looks like it's trending, it made a peak and may be trending lower. So use some caution when watching the Dow Jones Industrial Average. Here is a chart of the S&P 500 stock index, and this index is stronger than the Dow Jones Industrial Average. You can see from this chart that the red 5-day moving average is nicely above the blue 20-day moving average, indicating short-term strength, and the 20-day moving average in blue is above the 50-day moving average in purple, indicating intermediate term strength as well. So those are two very good signs for the bulls. And it also got above its prior highs of February 27th and March 12th and June 13th. We broke above those three highs back on July 11th. And right now, this chart is looking good in many ways. The only thing that is giving me pause is that there is there is a substantially smaller amount of shares being traded in the S&P 500 stock index since this rally began on June 28th or on July 3rd. So as the price of this index has been going higher, the shares being traded is falling rapidly, meaning there are fewer and fewer buyers, but also fewer and fewer sellers. There's just fewer activity or less activity in general. And it's really hard to get to higher prices in any investment or index if there's nobody participating. So I'm just going to keep an eye on that over the next week, but right now the S&P 500 chart is looking very good. Here's a chart of the Nasdaq 100 stock index, and this is the strongest index of the bunch. It is full of lots of technology stocks that have been propelling it higher. And you can see that the 5-day moving average in red is nicely above the blue 20-day moving average, indicating short-term strength, and the blue 20-day moving average is above the purple 50-day moving average, indicating intermediate term strength as well. So those are two positive things for this index. And it also got above its prior all-time high, which is from June up here. You can see that on July 12th, we broke above those prior highs and made a new all-time high for the Nasdaq 100. And we'll just see if it can hang up here in the stratosphere and continue higher. The one thing that gives me concern is that this particular index, the Nasdaq 100, may be creating a bearish ascending wedge pattern. And if I draw a line and connect all those three highs, you can see that connecting the high of January 26th and the high of March 12th, we had the high of July 17th. That's the top of the wedge, and the bottom of the wedge is formed beginning on April 2nd, and I'll draw that up there. And then let me turn off those moving averages so you can see it more clearly. That is potentially a bearish ascending wedge pattern that, if it is, it will break to the downside for the remainder of July, and then we'll see where we go in August. So I'm watching that very carefully to see if the Nasdaq 100 does have a failure and begins to fall. So looks good on the moving averages, but the wedge gives me some concern. Just use caution when considering that. Here is my favorite industry sector for the week, and that is the S&P 500 Consumer Staples Stock Index. And you can see that it peaked out on January 26th and began falling in a descending bullish wedge pattern. And it bottomed out after falling 17% from January 26th until about May 2nd, and then went sideways to slightly upward for the month of May. But then on June 7th, it broke out of that descending trend, and ever since then, it's been in a very nice uptrend. I drew the red oval with the yellow shading here to represent the breakout week, and ever since June 7th, it has been in a very beautiful uptrend, and that's about the finest thing you could possibly see on a stock index chart.